Hello, everybody. Thank you so much for making it. I'm Carl Frank, President of A&I Wealth Management. It's a pleasure to have you here. We are recording this event, so everybody who out there in the audience, we're going to keep you on mute and we're going to make you invisible. So please type in your questions into Zoom if you have any questions for us. And we'd love to answer those questions. We'll make sure we have plenty of time at the end of today's presentation to answer those questions. In Zoom, you'll see chat at the bottom of the window. Just click the chat button and type it in, and we'll make sure your questions are answered before the end of the presentation today. It's a pleasure to introduce our speaker today. It's Roger Bianco from American Funds and Capital Group. It's great to have you here, Roger. Roger's one of our most popular presenters. He does a really good job every time we've had him. Roger's Senior Vice President and Wholesaler. He's been here for 25 years, I think.
Yeah.
Wow, that's a long time. That's great. And you've been with Capital Group for 16 years.
Yes.
Right? Prior to that, you were with Van Campen.
Yep.
And it's a pleasure to have you back. Roger holds a Bachelor of Science degree from Illinois State University and holds the CIMA designation, that Certified Investment Management Analyst designation. The 22-year resident of Colorado, and you make your home in Castle Rock. So it's a pleasure to have you here. Thank you so much for making it. Please make yourself home at home. The presentation is all yours.
Okay, great. Thank you very much. So appreciate everyone being here. Thanks for those of you who are here in person and who joined us online. I always like to acknowledge the fact that the most precious commodity we have is not money. If worse comes to worse, we can try to figure out ways to make more. Can't make more time. And so you've given us an hour of your time here in the middle of the day. And so my hope and my prayer is that I'm able to use this effectively to arm you against what is likely to come this year, which is the full-on silly season, is what I like to call presidential election season. And a lot of times that has a tendency, the things that are said, the things that are done, and the narratives that are launched and everything tends to sometimes seep between the ears of the average investor, which then turns around and causes investment mistakes to be made. Things that can derail the investor's long-term financial security. And so we're going to spend some time digging into this. Before we do, I want to just set this up with a little bit of a story. So I was down in Pueblo, Colorado, 15 years ago. I guess it's now 16 years ago. It was the beginning of the 2008 presidential election cycle. It was later in the year, and it seemed like the polls were showing that then candidate Obama, later President Obama, was going to win. He obviously did, as we all know, served for 2 terms. But before that first term, I had an advisor who was talking to one of his clients and brought it up to me and said, Roger, what would you do with this? This investor client was a big fan of the former president, was active in the campaign, volunteering time, knocking on doors, all that. So you would think that would make that investor very encouraged by the fact that it looked like Barack Obama was going to win the presidency. The investor went to the advisor and said, as soon as Barack Obama wins, I want to go all to cash. Okay, why is it that you want to go all to cash? He was absolutely convinced that the reaction to Barack Obama being president was going to be so bad that the market was going to crash through the floor, and there's too many moneyed interest in the country, so on and so forth, down the sort of conspiratorial trail they went. And so that really did ring a bell with me, because that was an instance where the person that the investor liked, actively supported it and campaigned for, was going to win and did win, and they still wanted to take all their money out of their investment platform and their investment plan and go to cash. And so sometimes these things are just difficult to comprehend. And so what we're going to do today is we're going to take an objective look. Typically what I like to wear, they didn't do it today because I didn't have any, all my purple shirts are in the dry cleaners, but typically I do like to wear purple because in this capacity I have zero political agenda. Zero political agenda. And I would encourage you to have zero political agenda when considering what to do with your investments and how to invest your money and how to plan for the future with your financial advisor here at A&I. And so in a very apolitical way, in a very objective way, a lot of the data that we're going to share with you today and the studies that we've done and the literature that we've created here on the screen is based on a study of the last 22 presidential election cycles, going back to Franklin Delano Roosevelt's first election in 1932. So we're getting into statistically significant area here. We've got a lot of data points about what's happened in the market, how the market behaves in a presidential election year, and then afterwards. And so let's just launch right in here, right? So I think some of the things I'm going to say now might actually not apply to 2024 in a good way. In a good way. It's almost like, well, I'll come to that in a second. And so let's just kind of jump right in here on some of these things. It is difficult to have confidence in an investment or in an election year, in a presidential election year. And it just feels like the fever pitch, the tone and the tenor always kind of escalates every 4 years. And be prepared. You've probably already been told this as a voter and an American citizen, that from both sides of the political equation, that this is the most important presidential election in the history of the United States. And if X candidate wins and Y candidate loses, the republic will be lost, and all will be lost. And just a lot of that stuff, understand that it is, put it in its own context. People emotionally react to negative things 3 times more strongly than they react to positive things. So that's what the candidates are trying to do. They use hyperbole, exaggeration, and overstatement regularly in order to try to motivate people to get out and vote. So that's what that is. It really highly unlikely that this is going to spell the end of the republic. I mean, we've had elections that have had more contentious results. We've had elections that have resulted in a lot more turmoil and the like. You never know how people are going to react to the election coming, but it is highly unlikely that it is going to result in the end of the republic. And so be careful on falling for the rhetoric. The other thing I wanted to mention is that it's historically not unprecedented that candidates say hyperbolic things about their opponents. I mean, you don't have to look too far back to see this, but I did go way back. The campaign between Thomas Jefferson and John Adams. This was the 3rd presidential election in the history of the United States. You can go back and you can Google this. John Adams was trying to create an image of Thomas Jefferson. And what he was telling people was that Thomas Jefferson was indeed Satan. That's what John Adams said about Thomas Jefferson. This is a great campaign poster where Thomas Jefferson is sitting at his desk. He's got the plume and he's writing a document, presumably the Declaration of Independence. And over the shoulder of Thomas Jefferson, whispering in his ear, is a likeness of the devil himself. Right? That was a campaign poster in 1794, whatever it was. So not unprecedented. Actually, unfortunately, pretty routine. If you step back away from it and know that it's all hyperbolic, it could actually be pretty entertaining and funny. And so just a little bit of perspective on what you're likely to hear this year. Really trying to arm you with some perspective that'll help you get through the year with everything from your investment plan intact. Or if there are changes, it's not necessarily just based on the election, more based on your life. So what has happened over time? In our business, all of us in this room are licensed financial professionals, and indeed every investor in this room and joining us online like to see charts that go from the lower left to the upper right. That means the assets are growing in value, your prosperity is more secure. So what we have here on the screen is a picture of blue for the Democrats and red for the Republicans, which when I was a kid, I remember the colors being opposite. I don't think they were blue and red all the time, but I'm not sure who decides one color is the other. But you can see that the chart goes from the lower left to the upper right. And if you were able to dig into each presidential election term, what you'll find is that 3 things happen in the markets, whether the Republican is in office or a Democrat is in office. Those 3 things are: number 1, the market goes up. The market has gone up every time, whether there's a Republican or a Democrat in office. 2, the market doesn't go up. It actually stays flat. That actually happens more often than not. And 3, the market goes down. So the market has gone up, stayed flat, and gone down, whether there has been a Republican in office or a Democrat in office. This is the first data point on a journey that we're going to take here for the next few minutes, where I'm going to repeat the following phrase. The person who occupies the White House is relatively irrelevant to your success or failure as an investor. We're going to revisit that notion. what happens during election years to the market. And this is one of the things, I don't know if this is going to apply this year. That actually might be a good thing. So, a couple lines on this and some craziness. And actually, if you're following along with the hard copy, this is page 4. But basically, what this shows you is the market's behavior on average. The dark line is the 3 years that are non-presidential election years. And again, going back to every election year, every presidential election since 1932, 22 election cycles. The light blue line is what the market, on average, how the market behaves during a presidential election year. So this is very interesting. If you note, what you'll see is that the light blue line during the first year, and this actually goes out to 18 months past the year of the presidential election. So it's the presidential election year plus 6 months. What you'll see is the light blue line, January through June, roughly, so about the first half of a presidential election year, sort of muddles along, goes down. Why would you suppose that is? Typically during a presidential election year, during the first 6 months of the actual election year, the market kind of muddles along and actually goes down. On average, it goes down a couple percent. Why do you suppose that is? Why does the market do that in the first half of an election year typically?
Earning yield is really big, so the uncertainty is really high.
The word uncertainty, the U word, uncertainty. Yeah. I mean, I remember watching one of the debates, primary debates in 2016, I think it was. There were 16 candidates on the stage. 16. That field has got to get whittled down. The uncertainty of not knowing who the nominee is for the whether it's a Republican or Democrat kind of gets investors a little jittery, and the market doesn't really go anywhere. There's not a lot of confidence in making the decision to invest. There should be, but there isn't. The psychology of investing in an election year takes over. And then what you see is after the market bottoms, typically we haven't had a contentious convention in the United States for generations. So the conventions have largely become coronation ceremonies and kind of the kickoff of the general election. So typically by really even before June, but right around the middle of the year, even if it's a tight race and it comes down to 2 people for a particular party's nomination, we get a sense of who that person is going to be if we don't outright know who that person is based on the delegate count from both parties during the primaries. And so the market, it doesn't, again, necessarily matter whether it's a Republican or Democrat in the White House, but the market does like to know what they're facing, what they're dealing with. And so it's much better to have 2 candidates with certainty as opposed to 16 or 20 candidates with uncertainty. So in June, the market tends to bottom. And then what you'll notice is that we drew those arrows, the dark arrow from June of a non-election year to June of an election year to show you that out of chaos comes opportunity. When we get a sense of which parties are going to nominate which person, then the recovery line, the wealth accumulation line in the market is actually higher than a non-election year. Markets actually do better from June of the election year to June of the following year than they do when there is no election year. That kind of takes us to that phrase I'd mentioned, which is out of chaos comes opportunity. Right? Stocks go up, they go down, and they stay the same. But when they go down, that's a buying opportunity. Rule number 1 of investing is to buy low, sell high. That is stated incorrectly. It should be if you buy low, then you can sell high. And the chaos of a presidential election season actually creates opportunities to buy. So flip that psychology a little bit. Let your neighbors and your family worry about the markets. You take advantage of it to the greatest extent that you can if the markets are tumultuous in the first 6 months. Here's why I don't know if that's going to happen this year. Primary season might have ended last night. I mean, even in a scenario where, let me go back to that, in a scenario where Nikki Haley is trying to become the Republican nominee, and she's trying to unseat this incumbent for all intents and purposes. Independents in that primary voted. Some Democrats crossed over and voted. New Hampshire's like Colorado where you can do that. Donald Trump still won by 10, 12, 14, whatever percent it was. We might have this certainty before February 1st. Really does seem like, circumstances pending, that it's going to be Donald Trump and Joe Biden again. I'm just going to leave that where it is. But from a market standpoint, maybe we know what we get with Donald Trump. He's already been the president. Joe Biden's been around Washington, D.C. in politics for the better part of 50 years. So the market might actually have a better wealth creation scenario play out in 2024, given the fact that there's relative uncertainty. The spoiling factor, and I didn't get a chance to look at the data, we've not had a Ross Perot for 30 years. We might have a Ross Perot this year. Robert Kennedy Jr. could be the Ross Perot. He seems to pull from both Republicans and Democrats. So that really is the unknown. Not necessarily whether the Republican will be Trump or the Democrat will be Biden. It'll be what's the role of this third-party candidate. He seems to be making some inroads. And so stay tuned. But again, if that third-party candidate creates chaos, that creates opportunity. So it's almost from an investing standpoint a good thing to have a Robert Kennedy Jr. come in and take votes from both sides. That might throw the market a little bit of a curveball, offer opportunities for us to invest. So that's what typically happens during an election year. Very interesting. And this is kind of the thing that a lot of investors like to know. Certain sectors, and this is kind of standard operating procedure, certain sectors tend to do well after a Republican are elected, and certain sectors tend to do well after a Democrat is elected. And a lot of that is trade on perception, but not necessarily reality. And so you can see here, I'm not going to hit this too much, but energy after 1 year after a election generally is a sector that does better. Financials generally better 1 year or 1 year before the election. And then those two sectors have a pretty wide discrepancy 1 year after the election. And so that kind of changes. And the reason why it changes, and here's where, again, I said the person who occupies the White House is relatively irrelevant. Here's where that person can have an impact, potentially. And that impact is really through regulatory issuance. And let's just take the last 5 years or 8 years as an example. When Donald Trump's 4 years in office, he actually pulled back a lot of regulatory requirements from the marketplace across sectors. He did that not by eliminating regulations, but just by a stroke of a pen, an executive order to the executive branch saying, you no longer have to enforce these regulations. Day one, when Joe Biden came in, he, through the stroke of a pen, did the opposite and kind of undid all the deregulation that Donald Trump did. It's very difficult to get rid of a regulation. It takes years. And so really, a president, in order to get rid of a regulation, has to start on day one, knowing what they want to get rid of, go through the process, then win a second term, and to ensure that the regulation is completely gone. And then the next president would have to go through. So this executive order, this is where the president could have some impact. And frankly, this is why I work for a company, as Carl mentioned, Capital Group American Funds, that pays attention to these things and makes sure that if a president is elected and they want to take the regulatory state this way versus that way, we have to be aware of that. It's called regulatory risk. We have to factor that into our investment decisions because some of these things can change the fortunes of individual companies. But again, in aggregate, it doesn't throw the market off. It really doesn't throw the market off. What throws investors off is, as I had mentioned at the beginning of the talk here, all the hyperbole, all the overstatement about the importance of the election and the very peril of the country and all that stuff. You now know that's designed just to strum up people to get them to vote because negative campaigning works. It always has. And you also now know that it is not unprecedented for that to happen, as we did with the Jefferson-Adams decision. That does have a tendency to infiltrate the minds of some investors. And so here's what this shows you. It shows you where do people put their money in the 4 years that a president is in office. In year one, the blue bar being bigger than the green bar shows you, in year 1 and 2 actually, that people are more likely to invest their money in stocks than to put their money in cash. That changes in year 3, and it changes in year 4. Year 3 and 4, people are more likely to put their money in cash and less likely to put their money in stocks, whereas year 1 and 2, they're more likely to invest in stocks. Famously, I hear a lot of advisors use the phrase that they hear from some investors, I just want to wait to make a decision until after the election year. Now, as we've discussed, out of chaos comes opportunity. You probably, going to cash means you miss opportunity to invest. You miss typically the market being reacting to the uncertainty, stocks going down in value, so then you can make the decision to buy low. Whether a president increases the regulatory burden on certain industries or decreases the regulatory burden on certain industries, it is politically unpopular to run companies out of existence. So they stop short of that. You know, increasing unemployment is a one-way ticket to not getting a second term. And so there is zero incentive for presidents to run companies out of business. That's why it offers an opportunity when regulatory burdens change to invest. It's just adjustments. Great companies do not stand in the middle of the road and become roadkill during all these different kinds of gyrations in the regulatory burdens that they face. So the move to cash generally is somewhat counterproductive, because most people, when they're faced with that opportunity to invest in the first 6 months of a presidential election year, sit on the sidelines. They move money, or more and more people move money to cash and miss the buying opportunity that the chaos of a presidential election offers them. So we took this a step further, and we studied over these 22 presidential election cycles, what does this behavior produce? So there's three things basically that you can do with your money. You can invest, you can not invest, but remain invested as you are, or you can take the money out and go to cash, so sit on the sidelines. We now know that that's a tendency of a lot of people to do during the third and fourth year of a presidential election cycle. We're now entering the fourth. Last year, trillions of dollars went into cash. What is true, by the way, of everything that I've shown you here is also true of the last election in 2020 and this one so far, but just to an extreme. The early part of 2020, markets were down pretty significantly, obviously about 33% down because of COVID. So we had extenuating circumstances, which can offset some of these trends too. So what's the result of taking those three decisions? Focus on the bottom first. That's the sitting on the sidelines. This is what happens when people say to their advisor, I'm not going to invest. I'm just going to wait till after the election. I'm going to wait and see who wins. Most often than not, over the last 22 election cycles, that is the worst decision to make for your own financial prosperity, for your own ability to get to the objectives that you have. Right? In fact, it's 16 of the last 22 election cycles that produced the worst outcome. If you sat on the sidelines during the election year and then invested for year 2, 3, and 4 of that presidential election, of that president's term, that creates $10,000 does grow, but to not $15,000. That is the worst outcome the vast majority of the time. So you can see the psychology takes over. This is frankly why Apple Group and American Funds Investment Options, 98% of the assets we receive, the vast majority comes from financial professionals. We believe in the value of advice, because not most of these people that take their money and go to cash and create for themselves the potential for the worst investment outcome and for their own hurting their own financial situation are people that do not rely on financial advice. So if you're with the folks here at A&I, stick with them and listen to them. That is likely what they would tell you to do is one of the top two things. The middle bar shows you making consistent contributions. So contributing to your IRAs, or if you're taking the income in your portfolio that it distributes through the bond investments and through the stock investments through dividends and reinvesting those, it's a form of reinvesting, making consistent contributions, the investments and the income from the investments doing that for you. Or if you participate in any work retirement plan and every month you're contributing to your 401k or your simple plan or whatever work retirement plan you have offered, that's making consistent contributions. That creates more wealth doing that during a presidential election year and then the subsequent 3 years than sitting on the sidelines. $10,000 grew to $15,738. That's kind of the middle of the road option as far as the data goes. Staying invested is the best option. Combination of the two actually might be better. Consistent contributions plus staying invested. Staying invested, 14 of the 22 times produced the best outcome and generated the greatest wealth. Very counterintuitive, however, for me to say that, because again, the rhetoric is going to be crazy, and it's very easy for that to infiltrate your mind. So let me give you a vision here, and then we'll turn it over to Q&A. Here's the vision that I'd like to have, that I have for you all this presidential election year. Let's imagine you're at a four-way stop sign. For some reason, people have forgotten how to drive when four cars get to a four-way stop sign. If you get there first, that's car to get the same time car to the right, person that gets there first goes. But people kind of inch forward. In that instant, let's imagine that you're all listening to the same news report. And it's a news report about the election. And the language is crazy. They're playing the language of one candidate, and they're playing the language of the other candidate. And they're both calling each other Satan, metaphorically, if not literally. Y'all want the people in the other three cars at that four-way stop intersection to panic. I want you to smile. Think to yourself, great. If this campaign rhetoric gets crazy and it makes the markets jittery, I know that this is an investing opportunity. I'm not going to let this derail my long-term financial security or my financial plan. Because, again, the person who occupies the White House is relatively irrelevant to your success or failure as an investor. Now, make your contributions, put your yard sign in your yard, put your bumper sticker on your car, talk to your neighbors, and yell at your family, right? Because that's what we do. We talk to our neighbors, but we yell at our family. All that stuff is part of what we do as Americans and citizens and actively engaged citizens. But from the moment you step in the door or log on to your virtual meeting with your financial advisor here at A&I, keep it on the side. And remember that phrase. The person who occupies the White House is, believe it or not, relatively irrelevant to your success or failure as an investor. And isn't that great news? Because half of us are going to be happy and half of us are not going to be happy. So that's the best bit of news I can give you today. So let me stop there and open it up for questions. I'll turn it back to Carl, and you can open it up for questions.
Thanks, Roger. Great job.